Welcome to our deep dive
Uh,
into factoring and account management.
right.
We're going to be looking at how factors assess businesses,
Right.
the risks involved,
Okay.
and even some red flags to watch out for.
Gotcha.
And all of this is based on the International Factoring Association's Guide to Account Management.
Oh, nice.
By the end, you'll be thinking like a seasoned factor yourself, ready to spot opportunities and avoid potential pitfalls.
Yeah.
So I am so excited to get into this.
I know, me too.
Let's jump right in.
Absolutely.
Factoring often flies under the radar,
Yeah.
but it plays a crucial role in how many businesses
Mm-hmm.
operate and grow,
Yeah.
especially those that don't fit the mold for traditional bank loans.
Right.
This is what I find so fascinating about it. It's a
Yeah.
whole different way of looking at finance.
Yeah.
So for anyone who's new to this, can you break down what factoring actually is?
Sure. So, in essence, it's a way for businesses to unlock the cash that's tied up in their unpaid invoices.
Mhm.
So instead of waiting, weeks or even months for customers to pay,
Yeah.
they can sell those invoices to a factor at a slight discount.
Okay.
And the factor then takes on the responsibility of collecting payment from those customers.
So it's like an instant cash flow boost.
Yeah, precisely.
Okay.
And that's why it's particularly attractive
Yeah.
to, these certain types of businesses.
Right.
You think about high growth companies
Mm-hmm.
that need capital to fuel expansion,
Mhm.
startups that lack a lengthy credit history, or turnaround companies that are trying to stabilize their finances.
Right.
They all benefit from that immediate access to funds.
Okay, that makes sense.
Yeah.
But it's important to note
Yes,
that factoring isn't a loan.
correct. It's a purchase.
Yeah.
The factor is buying an asset.
Right.
The invoice not lending money to be repaid with interest.
Okay.
So that's an important distinction.
It is a key distinction.
Yeah.
Now, speaking of unlocking growth,
Yes.
I'm curious, why wouldn't every business choose factoring? What are some of the downsides or things to consider?
Well, the discount that the factor takes is a cost to the business.
Right.
Um, and it can also impact relationships with customers
Mm-hmm.
if they're not used to dealing with a third party collecting payment.
Right.
Um, and then plus, not all invoices are created equal.
Okay.
Factors are very selective
Mm.
about what they buy,
Uh-huh.
and they carefully evaluate both the invoice and the businesses involved.
This is where it gets really interesting to me.
Yeah.
It's not just about handing over an invoice and getting cash.
Right.
There's a whole risk assessment process, right?
Absolutely.
Okay.
Factors go beyond just checking credit scores.
Mm-hmm.
They dig deep into the financial health and stability of both the client selling the invoice
Okay.
and the debtor who owes the money.
Right.
So there's due diligence on the owners and management,
Okay.
a close look at financial statements,
Mm-hmm.
and an analysis of industry trends
Mm-hmm.
that could impact the business.
Right.
So it's quite comprehensive.
It sounds like they're piecing together a puzzle
Yeah.
to get a full picture of the situation.
Exactly.
So let's talk about the two main types of factoring,
Okay.
recourse and non-recourse.
Great.
What's the difference and how does that play into risk?
So these terms refer to who bears the loss if the debtor doesn't pay the invoice.
Okay.
So with non-recourse factoring, the factor takes the hit,
Mm-hmm.
except in cases of disputes about the quality of the product or service provided.
Okay.
So it's a bit like insurance for the client.
That sounds like a pretty sweet deal for the client.
It can be.
But I imagine it comes at a higher cost, right?
Yes. Non-recourse factoring typically involves higher fees
Right.
because the factor is taking on more risk.
Mm-hmm.
Now with recourse factoring, if the debtor doesn't pay,
Yeah.
the client has to reimburse the factor.
So it's a trade-off.
Yes.
Lower fees for the client, but also greater potential risk.
Right.
I can see how choosing between the two would depend on a lot of factors,
Yeah.
like the stability of the client's industry. Uh-huh.
And their confidence in their customers.
Right.
It's almost like choosing between different levels of insurance coverage.
That's a great analogy.
Yeah.
And it illustrates why factoring isn't a one-size-fits-all solution.
Right.
Businesses need to carefully consider their own circumstances and risk tolerance before deciding if it's the right fit.
That brings us to how factors actually assess businesses.
Okay.
You mentioned it's more than just credit scores.
Yes.
I've heard about the 4Cs of factoring.
Right.
Can you walk us through what those are
Sure.
and how they differ from the traditional 4Cs of credit?
You're exactly right. So while the traditional 4Cs of credit are
Yeah.
character, capacity, capital, and conditions,
Yeah.
factoring prioritizes one above all others,
Mhm.
collateral, in this case the invoices themselves.
Right.
But the other three still play a vital role in the assessment process.
Okay, let's start with character.
Right.
What are factors looking for here?
So think of it as a deep dive into the people behind the business.
Okay.
So factors conduct thorough background checks on owners and management.
Mm-hmm.
They scrutinize credit reports
Uh-huh.
and even look for any history of legal or financial issues.
Right.
They want to see a track record of responsible financial behavior.
So it's not just about the numbers.
Right.
It's about the people making the decisions.
Yeah.
A stellar credit history for the business owner
Uh-huh.
could really boost their company's chance of getting approved.
Absolutely.
Right.
A strong credit history demonstrates financial responsibility and increases trust from the factor's perspective.
Okay, so character checked off the list.
Okay.
Next up, capacity.
Right.
What does that entail in the world of factoring?
Capacity is all about a business's ability to deliver on its promises.
Okay.
So factors need to see evidence that the client can generate sales,
Right.
fulfill orders,
Mm-hmm.
and ultimately collect payment from their customers.
Okay.
So this is where documentation becomes crucial.
So what kind of documentation are we talking about? Is it the same for every business?
So the type of documentation varies,
Okay.
depending on whether the business sells goods or services.
All right.
So for businesses selling tangible goods,
Okay.
factors might require purchase orders,
Mhm.
invoices,
Yeah.
and shipping confirmations as proof that the goods were delivered.
That makes sense.
Yeah.
You need proof that the product actually made it to the customer.
Exactly.
What about service-based businesses?
So for services,
Okay.
it's about demonstrating completion.
Mm-hmm.
So factors might look for signed service contracts,
Uh-huh.
detailed invoices with proof of completion,
Okay.
or even client testimonials.
Right.
It's all about verifying that the service was rendered as agreed.
So different strokes for different folks,
Yeah.
but the underlying principle is the same.
Yeah.
Show the factor that you can deliver.
Right.
Are there any specific contract details that factors pay extra attention to?
You bet.
Okay.
Things like the acceptance language, termination provisions, pricing adjustment clauses, force majeure clauses,
Uh-huh.
and assignments and indemnification clauses
Hmm.
are all carefully scrutinized.
Wow.
These details can significantly impact the factor's risk, so they're not overlooked.
It sounds like factors need to be part detective,
Uh-huh.
part lawyer,
Yeah.
and part financial analyst.
That's a great way to put it.
Right.
It's a multifaceted role
Yeah.
that requires a keen eye for detail and a deep understanding of both business operations and finance.
This is fascinating stuff.
Yeah.
We've covered character and capacity.
Okay.
What about the third C, capital?
So this is where we dive into the financial statements.
Okay.
The balance sheet, income statement, and cash flow statement.
Mhm.
Factors analyze these documents to assess the company's overall financial health and stability.
Right.
They're looking at assets, liabilities, revenue, expenses, and cash flow patterns.
I'm sensing a theme here.
What's that?
It's all about mitigating risk, right?
It is.
Yeah.
That is a common thread.
Are there any particular aspects of these financial statements that factors zero in on?
So one key area they focus on is the ratio of tangible assets to intangible assets.
Okay.
So tangible assets,
Yeah.
things you can physically touch, like inventory or equipment,
Mm-hmm.
are generally considered more secure than intangible assets like brand reputation or intellectual property.
Interesting.
Yeah.
So a company with a lot of physical assets
Yes.
might be viewed more favorably than a tech startup with primarily intangible assets.
Right.
Even if the startup has higher growth potential.
That's exactly right.
Wow.
It all comes back to the factor's primary goal of mitigating risk.
Okay, so we've covered character, capacity, and capital.
We have.
What about the final C, conditions?
So this is where we zoom out and look at the bigger picture.
Okay.
Factors consider the broader economic and industry trends
Mm-hmm.
that could impact the business and its ability to collect payments.
So things like recessions,
Yeah.
supply chain disruptions,
Mhm.
or even changes in consumer behavior that could all factor into the assessment.
All those things are considered.
Imagine a company operating in an industry experiencing a sudden downturn.
Yeah,
Like what happened with oil and gas back in 2015.
right.
That ripple effect could hit related businesses hard,
They did.
impacting their ability to pay invoices and creating a chain reaction of risk.
Absolutely.
It's like factoring is not just about analyzing numbers on a spreadsheet. It's
Yeah.
about understanding the real world context
Yes.
in which businesses operate.
Precisely.
Wow.
A savvy factor takes a holistic approach,
Yeah.
considering both the micro and macro factor that could impact a business's financial well-being.
This is giving me so much to think about in terms of my own business.
I bet.
Knowing how factors evaluate risk
Yeah.
makes me wonder, what are some red flags they look for that might signal trouble brewing?
That's a great question, and it's actually a perfect segue into our next topic.
Okay.
Account management red flags,
Okay.
both on the debtor side and the client side. There are telltale signs that can raise eyebrows
Okay.
and warrant further investigation.
Okay, well, I'm all ears.
Right.
Let's dive into those red flags and see what we can uncover.
Sounds good. Let's start with some red flags on the debtor side. Late payments are always a concern, especially if it's a change from their usual payment patterns.
Yeah, that seems like a pretty obvious one, right?
Yeah.
If a customer who's always paid on time suddenly starts delaying payments, that could be a sign of financial trouble.
Exactly. It's a potential indicator that warrants further investigation.
Hmm.
Other red flags include rumors or news of financial difficulties, legal disputes they might be entangled in, or a sudden and unexplained drop in their orders.
Right.
These can all be signs that their ability to pay invoices is in jeopardy.
Yeah, it reminds me of that oil and gas slowdown we talked about earlier.
Mm-hmm.
When one industry takes a hit, it can have a ripple effect on so many other businesses down the line.
Absolutely. It highlights the interconnected nature of business and the importance of understanding industry trends. Now, on the client side, things can get a bit more nuanced.
Okay.
One red flag is a sudden and urgent need for funding, almost a sense of desperation to get that cash advance.
So if a business that's never used factoring before suddenly comes knocking, eager to sell their invoices,
Yeah,
that could be a cause for concern.
it's definitely something to pay attention to. Other red flags include irregularities in invoice numbers or sequencing changes in their billing practices without a clear explanation, reluctance to provide complete financial statements,
Right.
or inconsistent explanations for any of these changes.
It sounds like it's all about looking for patterns and discrepancies that don't quite add up.
Exactly.
The guide mentioned one specific example that really stood out to me,
Uh-huh.
a client shifting from using a payroll service to handling payroll in-house.
Right.
Apparently,
Right.
that can sometimes be a sign of potential tax issues.
That's a great example. It illustrates how seemingly unrelated changes in a business's operations can sometimes signal underlying financial problems.
Yeah,
It's like piecing together a puzzle.
looking for those subtle clues that might reveal a bigger issue.
So for anyone listening, this is valuable information, not just if you're considering factoring, but also in your everyday business dealings.
Right.
Being aware of these red flags can help you assess the financial health of potential partners or even your own customers.
Absolutely. These warning signs are relevant in any financial relationship.
Okay, let's shift gears a bit and talk
Yeah.
about the darker side of factoring.
All right.
We've focused on the legitimate uses,
Yes.
but I know there's also potential for fraud.
Right.
Can you shed some light on what that looks like
Yeah.
and how it can be avoided?
You're right. Unfortunately, just like any financial tool, factoring isn't immune to scams.
Right.
Fraud can occur on both the client side and the debtor side.
Okay, let's start with client-side fraud.
Okay.
What are some common schemes we should be aware of?
One common tactic is pre-billing,
Okay.
where a client invoices for work or goods before they've actually been delivered or completed.
Hoping to get paid up front and then disappear.
So it's essentially a bait and switch. They
Exactly.
create the illusion of legitimate transaction to secure the cash advance, then vanish without fulfilling their end of the deal.
Exactly.
Then there's fraudulent billing,
Yes.
which involves submitting invoices for sales that never actually happened.
Right.
They might create fake invoices, inflate the value of real invoices, or even invoice for fictitious customers. Wow, that takes some audacity.
It does.
It seems like that would be pretty easy to detect, though, right?
Yeah, you would think.
Wouldn't the factor eventually catch on when they try to collect payment from these non-existent customers?
You'd think so,
Hmm.
but perpetrators often go to great lengths to make these fraudulent invoices appear legitimate.
Really?
They might create fake websites or email addresses for these phantom companies, or even use the identities of real businesses without their knowledge.
That's scary.
Yeah,
It really highlights the importance of due diligence and verification on the factor's part.
yeah, for sure.
What about rebilling?
Okay.
Is that another type of client-side fraud?
Yes. Rebilling is a tactic where a client tries to disguise past due invoices as new ones to keep the cash flowing.
Okay.
They might change invoice numbers, dates, or customer names to make it seem like a fresh sale.
So it's like a financial shell game,
Yeah, exactly.
trying to keep those invoices circulating and avoid detection.
Exactly.
And then there's conversion,
Yes.
which involves a client cashing checks that are meant for the factor.
Right.
So they intercept the payments from their customers and pocket the money.
Right.
instead of passing it on to the factor.
Precisely. It's a breach of contract and a form of theft.
Okay, so we've covered some of the shady tactics used on the client side.
We have.
What about debtor-side fraud?
Okay.
How do debtors get involved in these schemes?
Sometimes it's a case of collusion,
Okay.
where a debtor works with a client to create fake invoices or inflate sales figures.
It takes two to tango, I guess.
It does indeed.
Yeah.
This type of fraud often involves some level of kickback or shared profit between the client and the debtor.
So it's a mutually beneficial scam, at least in the short term.
Uh-huh.
What about disputes?
Okay.
Are those always legitimate, or can they be a form of debtor-side fraud?
While legitimate disputes certainly occur, sometimes a debtor might claim non-delivery or faulty goods as a way to avoid paying, even if the claim is false.
So it's like a way to get out of paying a legitimate invoice by creating a smokescreen of complaints.
Exactly. They might stall payment, demand refunds,
Right.
or even threaten legal action to pressure the client and the factor into accepting a lower payment or writing off the invoice entirely.
This is all eye-opening.
It is.
It makes you realize that there are bad actors out there in every aspect of business.
That's why awareness and vigilance are so important.
Yeah.
By understanding the different types of fraud that can occur, in fact, right? Businesses can be more proactive in protecting themselves and mitigating risk.
This has been a fascinating deep dive into the world of factoring.
Yeah.
From the basics to the more intricate aspects of risk assessment and fraud prevention.
Right.
I feel like I've learned a whole new language.
Yeah. It is a lot to absorb.
Yeah.
But understanding these concepts can really empower you to make more informed decisions, whether you're running a business, investing, or simply navigating the financial landscape.
I completely agree. It's like having a secret decoder ring for the world of business finance.
Right.
Now, before we wrap up, I'd love to get your take on a key takeaway from all of this.
Okay.
If our listener could walk away with just one big idea, what would it be?
I'd say this factoring isn't just about quick cash. It's about understanding risk and making strategic decisions based on your specific circumstances.
Right.
So whether or not you ever use factoring directly, the principles we've discussed today, from evaluating business health to spotting red flags, can be applied across the board to make you a savvier financial player.
That's such a powerful point. It's like we've unlocked a whole new level of financial literacy. I feel much more equipped to analyze businesses, assess opportunities, and even protect myself from potential scams.
That's the goal.
Yeah.
Knowledge is power. And when it comes to finance, that power can make a real difference in your success.
Speaking of knowledge, you've been a treasure trove of insights today.
Oh, thank you.
Before we let our listener go, I have one final question to really make them think.
Okay.
Now that they understand how factors assess businesses, what steps can they take to make their own company more attractive to potential lenders or investors?
Oh, that's a fantastic question. It all comes back to those 4 C's we discussed.
Right.
So start by taking a hard look at your own financial practices.
Okay.
Are you demonstrating financial responsibility and building a strong credit history? Are you documenting your operations thoroughly and ensuring you can prove you're delivering on your promises? And are you keeping a close eye on your financial statements, focusing on building a solid foundation of tangible assets and positive cash flow?
It's like turning the tables and becoming the factor in your own business.
Yeah.
By understanding their perspective, you can identify areas for improvement and position yourself for greater financial success.
Precisely. It's all about taking a proactive approach to financial management and demonstrating that you're a reliable and trustworthy partner.
This has been such an insightful deep dive. A huge thank you to you for sharing your expertise and breaking down this complex topic in such a clear and engaging way.
Oh, you're welcome. It's been my pleasure.
And to our listener, thanks for joining us on this exploration of factoring and account management. Hopefully you've gained some valuable knowledge that you can apply to your own financial journey. Until next time, keep diving deep.